All right, hope everyone's doing well. So my new goal is to make these videos 10 minutes or less. I think it'll make them more interesting, and I want to try to focus more on having kind of a set goal for each video. And I don't know, it might be, I'll kind of figure out as I start making more of them. And if I could start making videos about 10 minutes a day, maybe certainly no more than 15 minutes at most, still leaning more towards 10. I could probably make a video every day, and I think that'd be helpful. So this video is really just going to be over today's price action. Coming into the day, we had, and this is the Emini. So the other day we had a gap up, pretty boring day. Two big bull bars. The interesting thing about this day is that this was the low. The open of the day was the low tick of the day, and typically Al talks about that being a 95+% chance, maybe higher than that you'll fall below it. So as soon as this bar closed, I thought we were going to fall below it, and we came close here, tried here, ultimately failed. We did fall below it the next day, but that doesn't really count. So boring day. I mean, really, when you get this big bar, you can buy. Probably okay. You can buy here, probably second leg up, or probably going sideways. And you get this bad price action, and then you start selling off, and you really just, once you go sideways for this many bars, you're going above the moving average, below the moving average, above it, below it, above it, below it. It's very peaceful, and it's so easy to get, lulled into thinking that, we have to have a breakout. And the worst thing you can do is, if you sell here, it's reasonable, but you're selling right above the moving average. Not a great thing. Support. So you get a big bear bar, disappointment. You sell here, you're disappointed. You buy here, and then you sell here. And, that's really, it's a reasonable buy. I don't want to go too fast. A couple legs down. Maybe a triangle, double bottom, always in long from the open. But if you're just selling, you're just going to get hit. So it's bad for stop entries. So let's go into today. It was certainly more interesting price action, to say the least. So coming into the day, we had, maybe I could do it kind of like this. There we go. Well, yeah, I'll just do it like this. It'll work. So on the open, a little bit of a gap down, broke below the low of the day, the low of yesterday. So you always have to be thinking there's two obvious resistance every day, or support. Support being the low of the prior day, resistance being the high of the prior day. And whenever the range is small, you always have to be aware that we could fall below one and go above the other. So when you have a bar like this, it's a small bar, 20% chance it is the low of the day. Now, when you get consecutive bars, I'm going to go ahead and just do this. It's just a little easier. When you get consecutive bars, you have to think about there's something special that happened here. We broke below the low of the day, the low of the prior day, turned up. We broke below the low of the prior day again. So on a smaller time frame chart, such as a 1 minute chart, if I can do this quick enough, see if I can. It's two failed breakouts below the low of the day. The low, when I say the low of the day, the low of the prior day, which was yesterday. So it's a reasonable buy. Or you can wait for 3 bars and you buy the close on a 15-minute chart, bull bar closing on its high, as you can see right here. So it's reasonable. Either way, traders will buy. So always in long, certainly by 8:45, you can put your stop below. Then you get 4 bars up, 5 bars up. Odds are you'll get a second leg up, and it's reasonable to think that maybe we'll go to here. The one thing I'm confident about, I don't know if it's 8:50, certainly 8:55 is. I do think we're going to go to the high of the day. Now the only issue traders have is the obvious one, obvious resistance. These bars are great, but there's a lot of overlap. tails below, tails below, tails below. Big bull bar, but smaller body. And then a big body, but a tail, and then disappointment. Now, I wouldn't sell below this bar. I think it's probably more profit taking. And, Al talked about this on a different bar, but it's the same concept. So let me see if I can kind of, figure this out. Let's go to maybe, let's go to like a 30-minute chart. Or maybe a 40-minute chart. Now, well, so if you think about it, if you were to buy the close of this bar and put your stop below, your risk is from here to this close. However, if you're to say, gee, this is a pretty big trading range, maybe, if this is a bar, if this right here is similar to this, Al talked about this at the end of the day. He said a lot of times when you have, he had this drawn, 3 pushes down, and he said a lot of times when you get a really big bull bar and the context makes sense, 3 pushes down, 1, 2, 3, close to the bottom of a trading range, but the risk is big. Whenever the risk is big, a lot of traders will they will wait for the bar to trigger, and then they'll set an entry with the limit order 50% of the bar. So they'll wait for the bar to trigger, and then they'll buy 50% pullback, betting it'll go up. Well, that's really the same concept over here. Although they didn't technically buy above this bar, what they did is, and you can look at it in many ways. They couldn't really buy 50% of that. Maybe they saw these 2 bars and tried to buy 50% of these 2 bars, which they were able to. That's one reason why tails form. Big risk, so you buy, stop down here. One way to reduce your risk is to obviously buy lower, and an obvious magnet is a 50% pullback here. And we also tested the close. So anyways, it's always in long, stop below here. If you do buy up here, you have to understand you may get a very deep pullback. And when you think about this bar. At some point, this bar was closing on its low, or looked like it was going to, then it turned up. So it's reasonable to buy above, put your stop below. You don't have to get out of shorts. If you do get out, there's no credible, for sure reason to get out. So if you do, you got to get back in above this bar. Do you get out below here? Probably not. It really didn't even trigger. So bulls probably move their stop to here. Strong enough breakout, probably at least a second leg up. We still have that target of the prior day, which I said I think we'll get above. Consecutive bull bars, probably a little higher. Then the best looking bull bar of the day in what could be a trading range day. Notice it's by the close, but as soon as we get above an obvious target, the high of the day, top of a trading range, we pull back. So you always have to be suspicious that we're breaking above obvious support or resistance, and turning down. So when that happens, be aware. Possible second leg trap. And then we have a second leg, and this was really kind of a very strong warning. This told a lot of traders we're not going much higher. It's a possible second leg. You could argue 2 legs. Leg 1, pull back. Leg 2, or leg 1, 2-legged pullback. Leg 2, leg 1, pull back. Leg 2. Trading ranges are always forming 2 legs, and then one of the reasons for that is, just like over here, if you're short, the objective, what's the worst thing you can do in a trading range? Let me try to explain it this way. The worst thing you can do is sell at the bottom. I'll and really here's not a good example, but I'll sell the open, and I'll stop myself out at a new high of the day, and then I'll say, oh, it's going up, I'm going to buy, and then I'll stop myself out at the low of the day. The worst way you could trade a trading range. What's the obviously doing the opposite is much better. So one problem with trading ranges is they force traders to buy higher than they want. So just like this, it's forcing traders to buy higher than they want. So when they get the second leg, they know it's a trading range. They know it may go further than what seems reasonable, but it will still fail. And let me just kind of I'm going to explain one thing real quick. Very often, I'm going to have to get rid of some of these lines, but this is the high of the day. So what I kind of want to explain is very often, if you use a wide stop and do something reasonable, usually you can make money. And I'm not going to make the 10-minute mark, but I'm going to try and do the 15-minute mark. So if I sold this high, here's my actual risk from here to the high of this tick, technically one tick above. So you can see that 1 times my risk would actually be the lows of these bars. So what does that mean? Well, if I was to sell the high of the day, and once I see price start to turn down, I could calculate my actual risk from this high to this high. I could set a target the same distance because it's a 60% trade. Anyways, but from an always in perspective, let me get back to the main focus. It's always in long, never one always in short. If you get out, you get long again. Stop down here. Maybe you could put a stop below. I would not. Clearly always in long, top of a trading range. Bulls, they can get out there. They probably should get out there. Certainly by the low of this bar. I would probably get out. If I didn't get out below this bar, I would certainly get out as it's going down. 3 consecutive bear bars, probably going to have at least a second leg down. So not really a great buy. And, do you buy above? You could, but it's also a tight trading range. So again, not a great buy. Big bear bar, bad follow. Big bear bar, disappointing tail. So could get bad follow through. And turns out we did get bad follow through. A lot of bears, if they sold the close, they were disappointed. Tried to get out of break even, could not. And we just started rallying. Now, one thing you have to be thinking about is we may go above here, but you also have to make sure we may stall up here because bulls buy disappointed, scale in, and become disappointed again. And then we got we're trying to bottom, trying to form a bull flag. Boom, bear breakout, probably going at least for a measure move down. Certainly probably going to have a second leg, even if we get a bull body. You can see we're selling off. Surprise bar, expect a few legs down. We got the measure move. So some bulls will buy. If I was trading always in, I would get out above this bar and you'd probably have to get short below this bar, or at least get out of longs below the bar. 3 consecutive bear bars, probably forming a broader wedge, 1, 2, and 3. Maybe something like that. Broke below the lows of the prior day, bottom of trading range. So probably going sideways. So that's all the time I have. Thanks for watching.